South Korea, or Vietnam, Bangladesh, Pakistan, India, America, they all decrease their home currencies, right? Number two, actions by one government to weaken its currency causes another countries to strengthen, right? If you decrease the value of dollar against yuan, yuan will appreciate. It's not like that dollar will decrease and yuan also decrease. This kind of concept can never be occur. It's mathematical equation, okay? There is, beside, behind the scene, there is mathematical, theories, mathematical formulas are there. So if you appreciate dollar against certain currency, it means the other currency will depreciate. If you want to appreciate, if you want to depreciate, the other currency will appreciate. If you want to your home currency to appreciate, the other currency will depreciate. It's vice versa. Number three, government's attempt to influence exchange rates can lead to international dispute as well, right? Like the famous dispute is between, again, US and China. The US claim that the Chinese are artificially deflating or depreciating your yuan against US dollar so that US and China has greater deficit and Chinese are eating US jobs. Let's see that. US exporters and government officials also frequently claim that the Chinese government maintain a value of yuan at artificially low level against dollars. They suggest that Chinese government should reevaluate the yuan upward in order to correct the US balance of trade, which is deficit. So this issue brought to the light in financial crisis and when the US economy was very weak. The US government officials were searching for solutions to stimulate US economy. Some government officials believe that if the Chinese yuan is revalued upward, the US exports will increase and imports would decrease, which create more jobs. I'm just reading this because I already explained all the concept here. So what happened? The US claimed that the Chinese yuan should be revalued upward, which means it should be more expensive for the US people to buy Chinese good. From that, we can support our country and we can create more jobs for the US. So again, that philosophy, be American, buy American, in order to survive in this financial crisis. So let's talk about the Chinese perspective. Chinese say that, no, your arguments are valid, but Chinese government say that the trade imbalance is highly influenced by a difference in cost of labor between two countries. Further, if China accepts the claim that Chinese yuan gonna be revalued upward, then what happened? If the Chinese government revalued the yuan upward to make its product more expensive for the US importers, then what happened? The US will shift its purchases from China to other countries where there are low wages still prevailing over there, like Mexico, Malaysia, Vietnam. If the US consumer just shifted their purchases to these low wage countries, does that mean the US government officials will argue that these low wages countries also need to revalue their currency and to reduce the balance of deficit? So basically, Chinese are claiming that what if we increase the value of yuan to look our products more expensive to US, then US will buy from where they would find cheaper things, and cheaper things means that they can buy from Malaysia, Mexico, and Vietnam, and now Bangladesh and India. Then what's the profit of in this, for the Chinese? And also for the US as well. It means if US is having huge deficit with China, then that deficit gonna be shifted towards huge deficit maybe from Malaysia, maybe from Mexico, maybe from Vietnam. So your argument, Mr. Trump, is invalid. Why? Because it does not fit into the definition of international finance, and it is not answered by international economics as well. Any question? Okay, if there is no question, then we'll talk about factors affecting direct foreign investments. So let's talk about this. Do you understand what is DFIs, direct foreign investment, or FDIs, foreign direct investments? It's one and the same thing. Foreign direct investment or direct foreign investment. In this book, it is named as direct foreign investment. So what factor causes other companies to invest in your countries? First of all, changes in restrictions, which means if restrictions are lower down, then new opportunities have arisen from removal of government barriers. If you allow foreign governments to come to your country and install plants, machinery, or buy lands or install factories, then foreign direct investment going to be increased. Privatization, what does it mean? It means you're selling your government control entities government controlled institutions or entities to other governments or other countries. So what happened? It stimulated the foreign direct investments. Plus, managers of privately owned businesses are motivated to ensure profitability, further stimulated DFIs. So the government control institutions, they don't care about increasing their profitability. Why? Because in government system everybody is treated same. So those who work hard, they will also receive the same salary. So those who don't work hard, they also receive the same salary. So the motivation to work hard, they lose in privatization. So that manager who work hard will get the bigger share of their profit as well. So their salary increases. So what happened in privatization? Profitability increases. So privatization also increases foreign direct investments. So let's talk about, I think I have, okay, in coming slides, I will be having a small video to show you regarding the DFI. So the third one is potential economic growth. If your country's economic growth is predicted towards higher levels, then other countries will come to your country and invest. If tax rates are decreased, what happens? People will invest in your country. Exchange rate, what does it mean? So firms typically prefer to pursue DFI in a country where local currency is expected to strengthen. What does it mean? It means right now the currency is depreciated or at its lower value. So they invest right now because they can convert their strong currency into multiple or into many local currencies, and they can buy a huge land over there, install a business over there, purchase more shares. And what happened when they already installed, the currency start to appreciate. What happened when they convert the local currency into their own currency? So they will get more currency. So that's confusing, right? Let me just give you the example here. So when US should invest in China? When Chinese yuan devalue. When Chinese yuan devalue, it means they need less dollar. For example, they need 1 million yuan. They need less dollars to convert into 1 million yuan. They invest it here, they make a factory, and after 1 year, for example, yuan appreciate, right? Yuan appreciate means dollar depreciate. It means when they convert their currency into, yes, when they convert their currency into dollars, then their dollars gonna be increased. For example, they converted, for example, $100,000 into 1 million, and now yuan is increased. So the same 1 million yuan, when they convert it into dollar, they receive $110,000, right? So they benefited from profit as well. Plus, if they just sell their original amount, they will receive more dollar. So that's against their own currencies, managing the exchange rate. So what we learn from here? We learn from here not only the institutional investment plus also the personal investment as well. For example, if I have a job in China, and if I know that uh, you know the currency gonna be my home currency gonna be depreciated, so I will convert my earning into yuan, and then after some time when my local currency or my home currency or my country currency is decreased, then I convert yuan into my home currency, and then I will receive more money. Similarly with the DFIs, direct foreign investments. So you invest, you as a MNC or as a businessman, you invest right now where the currency is low, and you invest over there, make a factory, run the factory, and you reap out your benefits when its currency start rising. Any question? No?
No, no.
Let's talk about the portfolio investments. What does it mean? It is a form of DFI, direct foreign investment, which is investment in the stock exchange. There are three levels of direct foreign investment. Number one is either you go through portfolio, that is the number one stage. Number two, acquisition or merger. Number three, establishment of your subsidiary. Number one, when you see that a country is expected to grow, but at its initial stage, in that case, there is huge risk. Why? Because there is political instability is over there. New prime minister come and maybe increase the tax rate, or maybe restrict the DFI, or maybe say that you cannot, take out dollars to your home country, right? So there is like capital outflow restriction over there. So there is a lot of political instability. So what other countries do, they test, and the first tested, they invest in their stock exchange. We call this portfolio investments because it's very easy and the rollout plan is very limited. For example, you just need to sell the stocks and bonds and convert your money into your home currency, and that's it. The risk is lower. So what happened if you, what are the factors that causes increase in portfolio? Number one, tax rate on interest or dividend. If you announce that those who invest in our stock market, their dividend and interest incomes are not taxed, in that case the other countries will invest in your